I want to start with a fact that should completely change how you think about the stock market. Since 1926, the majority of all US stocks lost to Treasury bills over their entire lifetime. Not lost to the market, lost to T-bills. 58% of every stock that ever traded underperformed what is basically cash in the bank. Hold that number in your head because everything else today flows from it. So let me say it as plainly as I possibly can. Most individual stocks are not winners. Most individual stocks are not even average. The cold, hard 100-year truth is that most individual stocks are losers. And once you really understand why that is, and why it still leaves the market as a wealth-building machine, the way you invest should never quite be the same again. It gets darker. The single most common outcome for an individual stock is not a small gain, and it is not a small loss. It is total wipeout. When you line up the lifetime return of every stock in history, the most frequent result of all is negative 100%. More companies go to zero than land on any other single outcome. And before you think this is some doom and gloom hot take from the internet, it is not. It comes from one of the most cited and respected studies in all of modern finance by Arizona State professor Hendrik Bessembinder, published in the Journal of Financial Economics, which leaves us with a genuine paradox. If most stocks lose and the most common outcome is going to zero, then how on earth has the stock market made so many people so wealthy over the last century? The answer is the single most important idea in investing that almost nobody ever explains to you. Chapter 1. The coin flip you usually lose. Bessembinder studied roughly 26,000 US stocks across 90 years of market history, and he found that only about 43% of them beat one-month Treasury bills over their lifetime. The other 57% did not. So when people say stocks go up over time, what they really mean is the index goes up over time. The typical stock inside it is a much sadder story. So when you buy a single individual stock, I want you to picture the real odds, honestly. In your head, you are hoping to ride the next great winner. But the historical base rate says that more often than not, what you actually end up holding is something that lags safe, boring, government-guaranteed cash. And it is not just lagging cash. About half of all the stocks in the study had a negative lifetime return. That means they did not just underperform T-bills, they actually lost money in absolute terms, taking real dollars away from the people who held them from start to finish. So here's the first hard truth. The typical stock is fragile. It is far more likely to quietly disappoint you, or blow up entirely, than it is to mint you a fortune. That is the base rate of stock picking, and almost no one tells you about it before you start. And it gets worse the longer you hold. Over any given decade, the median individual stock dramatically lags a simple market index. Why? Because the index quietly keeps absorbing the next batch of winners as they emerge, while your one-hand-picked name almost certainly does not. Time, which is the investor's best friend in an index fund, is often the enemy of a single stock. Chapter 2, the 4% that built everything. Now here is where it gets genuinely wild and where the paradox finally resolves. Across those same 90 years, US stocks created roughly $35 trillion of net wealth above Treasury bills, $35 trillion, an almost unimaginable amount of prosperity, the engine behind pensions, retirements, and generational wealth, and yet nearly all of it traces back to a tiny, tiny sliver of companies. The market is wildly successful and mostly made of losers at the same time, and that is not a contradiction. Just 4% of all listed companies, the very top performers, accounted for the entire net wealth gain of the whole stock market. Let that sink in. The other 96% of companies, when you add them all together, collectively did no better than Treasury bills. As a group, they were awash. And it concentrates even harder than that. The top 86 companies alone, that is 0.3% of everything, created more than half of all that wealth by themselves. A few dozen names did half the heavy lifting for an entire century of investing. We are talking about the all-time giants. The names at the very top of that list are exactly the ones you would guess. The great decades-long compounders like Apple, Microsoft, and ExxonMobil, followed by a very, very long tail of everything else. So the market's famous return is not some smooth, average experience spread evenly across thousands of names. It is much closer to a lottery, where a handful of winning tickets quietly pay for all of the thousands of losing ones. And here is the real punchline of that lottery. If you had simply skipped the best 4% of stocks, just left those few names out of your portfolio, the entire rest of the US market, all 96% of it, would have collectively returned roughly the same as a savings account over 90 years. The winners are not a bonus on top of a good market. The winners are the entire market. Chapter 3, the hidden force behind all of it, skew. Think about the simple math of owning one stock. On the downside, a single stock can only ever fall 100%. You can lose everything you put in, but you can never lose more than that. On the upside, though, there is no ceiling at all. A true winner can climb 1,000, 10,000, even 100,000% over its lifetime. That asymmetry has a formal name. Stock returns are positively skewed. A small number of enormous winners drag the overall average way up, far above what the typical middle-of-the-pack stock ever actually delivers. The average and the typical drift miles apart. Here's the intuition. Imagine a room where the average net worth is $10 million. That sounds like a room full of rich people. But it might just be a room of ordinary folks, and one billionaire who happened to walk in. The average is technically true, yet it describes almost nobody actually standing there. Stock returns work exactly the same way. And this is the trap that catches almost every stock picker. When you choose just a handful of stocks, you are far, far more likely to draw from the boring middle or from the outright losers than you are to grab one of the rare giants that actually drives the entire market forward. Put it in the most concrete terms I can. A single stock that climbs 10,000% over its life can, all by itself, quietly pay for 100 other stocks that each went to zero, and still leave your portfolio far ahead. That is the entire engine of the market. A few violent winners do not just beat the losers, they completely bury them. Chapter 4. And no, this is not just an American quirk. Binder ran the exact same study on global markets, roughly 62,000 stocks across more than 40 different countries, and the result came back almost identical. 61% of all those global stocks underperformed US Treasury bills over the period studied, and worldwide, just over 1% of all companies, only about 800 firms out of 62,000, created the entire $44 trillion of net global stock market wealth. Everyone else added together was essentially a rounding error. Different countries, different decades, different industries, different currencies, and yet the same exact shape shows up every single time. A tiny few winners quietly carry absolutely everyone else. So this is not bad luck. It is not one weird era or one strange country. It is the fundamental mathematics of how stock returns are distributed, and it is held up across a century of data and tens of thousands of companies. The conclusion from more than 60,000 companies and a full century of market history is brutally simple, and it reads the same on every single continent. Chapter 5. So what do you actually do with all of this? If a tiny handful of stocks create essentially all of the wealth, then every stock picker on earth, whether they realize it or not, is really answering just one single question. How confident are you truly and honestly that you can identify those rare future winners in advance? Before the rest of the entire world, including thousands of full-time professionals with supercomputers, identifies them too? Because that is the bet you are actually making. When you concentrate your money into a few names, you are betting that you can. But the odds we just walked through say you will most likely miss the giants and end up holding the losers instead. Own the entire market though, and you are mathematically guaranteed to hold every single future winner from its very first day automatically. And this right here is the real mathematical reason that simple index funds quietly beat the large majority of professional stock pickers over time. It is not magic, and it is not luck, and it is not some trick of low fees alone. A broad index fund simply guarantees that you already own the few winners that matter, every single one of them. Instead of betting your entire financial future on being clever enough to find them yourself before the rest of the world does. So flip the way you think about diversification. It is not the timid, defensive, scared money choice that people make it out to be. Given how violently skewed stock returns actually are, owning the whole market broadly is simply the mathematically rational thing to do. Or as Jack Bogle, the man who founded Vanguard and gave ordinary people the index fund, put it far more simply than any professor ever could. So the lesson is not that the stock market is a scam or that stocks are bad. It is the opposite. The market builds enormous wealth, but it does it through a tiny few names you cannot reliably predict. Time in the market, owning all of it, beats trying to guess which handful will win. You don't have to be smart enough to find the needle. You just have to be patient enough to hold the entire haystack while the rare winners quietly compound for years. So let me leave you with the whole thing in a single breath. Most stocks lose. A tiny few create absolutely everything. And because you almost certainly cannot pick those few in advance, the single smartest, most rational move available to you is simply to own them all. If this changed the way you see the market, that's exactly why this channel exists, to give you the real math behind the money, not the hype. So follow Market Minute and tell me down in the comments, now that you have seen the numbers, would you still try to pick single stocks? I would genuinely love to know.